Welcome back, everybody. What a wild day in the crypto markets. We have Ethereum up 12%, Bitcoin up almost 8%. We're going to talk about what happened and what caused that. And then we're going to dive into where we're headed next, because I think that there's a good chance we head back to the downside in the coming weeks. And we're going to analyze why and then finish up with a very technical Bitcoin chart here at the end. So let's get right into it. The first thing that I want to talk about, obviously, is what everyone's talking about. We had a 75 basis point hike for the second time, and Jerome Powell, the head of the Fed, actually signaled a potential third hike coming in September. So this is definitely something that we need to watch. Monetary policy kind of runs the market at this point. And why we're pumping is because this was somewhat expected, the 75 basis point hike. If we saw a full percentage basis point hike, we probably would have seen an immediate move to the downside. So that's one of the reasons why we're pumping. The other reason why we are pumping is that the Fed actually reached their target neutral rate. So what a neutral rate is the prevailing rate at which the economy runs at its potential, without overheating or excessively cooling down. So with this 75 basis point hike, the Fed just reached its estimate of neutral rate. And so from here, they technically aren't contributing to economic overheating anymore. And so what their monetary policy is going to be doing now is just being restrictive from this point, right? So there's no more monetary policy contributing to overheating. It's more going to be on the supply side of the economics of the U.S. And so this is kind of a big moment, and that's part of why we're seeing some bullish movement to the upside. We expected the 75 basis point hike, and the Fed has reached a target neutral rate. So those are kind of some of the reasons that are playing into the most recent pump that we're seeing. Now we're going to get into a big announcement that's coming out tomorrow that I think is going to start sending us back to the downside. And that is the GDP second quarter advance estimate. Now this will be coming out tomorrow at 8:30 a.m. I believe that's Eastern time. I could be wrong there, but it's going to be coming out tomorrow morning. And why this is so important is because technically, economically speaking, when a country reaches 2 consecutive quarters in a contracting GDP, that means that they have entered a recession by definition. Now, what we're seeing from a lot of the head banks, head analysts, is they're kind of split, but more so leaning towards a contraction in the economy. So back-to-back negative quarter GDP growth, which would mean technically the U.S. is in a recession. So we had the negative GDP decline of 1.6% last quarter, and now we're forecasting, somewhere between a percent increase and a 1.2% decrease. So we have Moody's, which is a very, very sought-after economic consultancy. They see a 1% decline. Goldman Sachs sees a 1% increase. They tend to always be to the upside, though, at least in my experience. And we're also seeing the Atlanta Fed's GDP Now tracker has a negative 1.2% estimate for the quarter. So I believe the official Fed estimate is around even, maybe a 0.1% increase. So, relatively even. But if we see another negative contraction in GDP, we're going to see headlines saying that the U.S. is in recession. And I think you guys can do the math from there, right? If we are officially in a recession, people are likely going to start more so panic selling, right? And kind of freaking out, wanting to have more cash on hand. 9 times out of 10, when you see recession announcements, the markets across the board will contract. So I think people need to be very, very careful not to necessarily FOMO in here now and be super, super patient. Obviously not financial advice, but just kind of looking at it from a very realistic perspective. We're likely going to get bad news tomorrow. We're hoping that we're at least maybe at a 1% or even increase in GDP, but it's really now kind of 50-50, more so leaning towards a potential contraction in the US GDP, meaning a official recession. And the other thing that we saw was obviously this interesting Coinbase SEC probe, which was then followed up today with a massive sale by Kathy Wood of ARK Invest of Coinbase shares. So she sold 1.4 million shares. That's tens of millions of dollars. And obviously she'll be putting that elsewhere, maybe holding that on the side for potential investment opportunities as we see more of the market kind of tank here maybe in the coming weeks. But we'll see what happens there. But really, really interesting to see how this SEC probe plays out. I think that in terms of exchanges, it's really important to remember, guys, that you only own your crypto when it's on when it's in your wallet. Crypto on exchanges is just basically numbers. It doesn't mean that it's there waiting for you to take it out. We've seen that in some of the recent liquidity issues, things like Luna, Voyager, Celsius, etc. So definitely be very careful there. Now, I want to finish off with a little bit of Bitcoin analysis, and we're going to look at this chart in particular, and I want to focus on a couple of things. So you're going to first notice the vertical lines here, and this represents the Fed hike meetings. So this was the first time we hiked. It met expectations. This one was a 50 basis point expectation. We had 75, so we tanked. Here's another 50 expectation, 75 tank. And then we kind of stayed relatively even between the last two hikes. So what I want to point out here is that we necessarily have never been net positive after a interest rate hike, right? So we saw the hike happen here. We did get a little bit of a pump, right? Because it met expectations. But then if you look, we actually ended lower, or if not even, at the next hike. So the same thing happens here, here, and here. And between the last two, like I said, we ended up about even. And I think that's very, very important to note. So to think that we're just going to buck the trend now, is very, very, I don't know. It's really hoping for a lot. So I think people need to recognize that, just because we're pumping today, in a very, very good way, doesn't mean that that is going to last. Now, if we look at more so where we're at here currently, I have the 200-week moving average here up in blue. And what you're going to notice is that we have not been able to stay above this whatsoever in the last month once we fell below it. So you can see resistance here, resistance here, resistance here. We actually get above it for a second and then come back down. And now we're actually getting, currently as we speak, after this pump, we've pumped up to the 200-day simple move, the 200-week moving average. And now we're actively getting rejected by it here right at that 22.6, ish mark. So we snuck above it just for a little bit today, and now we're getting actively rejected at the time of this recording at the 200-week moving average. So I would expect that we start to, maybe at the most see a 24K Bitcoin and then start to kind of retract a little bit more and fall below this 200-day moving average, 200-week moving average, which then we'd expect, some support here at the 20.5 level, and then we'd probably head back down to that 18.9, 19 level once we fall down a little bit more. If we get that recession news tomorrow, I would expect a pretty rapid decline in Bitcoin. I don't know if we're going to replicate what we did today, which was, 9% pump essentially in the 24-hour period. I think that we could see something, 5 to 7, maybe 8% that we go down tomorrow or throughout the next couple of weeks. But I'll be very, very careful because we do have, this is another really, really important point. We have the longest period between Fed rate hikes that we've ever had. So if you can see here, we're typically a month between Fed rate hikes each time. In this marker, we are actually still another 2 months out from the next Fed rate hike. So people have twice the amount of time to speculate on what the Fed's going to do. That means twice as much uncertainty, and markets do not like uncertainty. So I think best case is we kind of stay and consolidate under that 200-day, 200, it keeps on saying 200-day, 200-week moving average. And then, leading up to that hike, maybe we get a pump. If we get something that's expected, we get another thing like that. And then maybe we keep consolidating. But I think best case, we see some solid consolidation. Worst case, I think, we not only lose this 20.8, 21K support, but then we fall down easily to 19. Now, if we lose this, 18 to 17.5 support, we're looking at playing in this this purple rectangle area. So I wouldn't be surprised if we're playing between 13 and 17.7 in between the next couple hikes. We get our hopefully final capitulation and potential bottom between these next two hikes. That's a lot of speculation. Anything's really, really possible. But I think it's important to realize that we're definitely not out of the woods, in my opinion. I think we have a long way to go. And I wouldn't be surprised if we're playing between 17.7 and 12.6, 13K down here in our purple rectangle. And just to remind you guys, we have that area set up because that's the area, basically this bottom at 13 is our previous resistance that we broke through before that big pump last year, actually 2 years ago at this point, almost a year and a half ago. And so that's why we have this as our potential bottom, because that was the resistance that we broke through about 2 years ago, a year and a half ago, before we had this insane pump to 69K. Now, one last thing I want to mention is to the upside, and this is more kind of on the risk management side, just expectation side. To the upside, I think the highest we possibly could go, obviously, is this next fib level at 29.7. The issue is that to break that 200 week moving average would take some solid momentum, some serious institutional buying. We haven't seen ourselves be above that, since June 14th, actually, before that last Fed hike. So since these last two Fed hikes, we have not been above that 200 week moving average. I think that's important to note. And now we have the longest amount of time between Fed hikes that we've ever had. So definitely something to focus on, definitely something to pay attention to. But I hope that this gave you, somewhat of an idea of what's going on, caught you guys up, and gave you some intel in terms of what could be happening next with these charts. So thank you so much for watching, and we'll see you in the next one. Bye-bye.